Hello everyone, and welcome to Module 5 of our series in Being Your Own Boss, Courageous or Crazy. Today we have a guest speaker that we're bringing to you to talk about early stage fundraising. And Leslie, why don't you go ahead and introduce Gordon?
Thank you, Carl. Yes, I'm very excited to introduce Gordon Nuttall this morning. I know Gordon from the Quid Novi Festival that we have here in Fort Collins, Colorado. And he was our first recipient of our Innovator of the Year Award for his invention, the Flip Pal. So he's been very instrumental at helping local people generate some knowledge about how to fund their businesses. So I'm very excited to bring Gordon Nuttall to you this morning. Gordon, welcome.
Thank you, Fran. It's good to be able to present some of the information that I've gained over the last 2 years. Our company is called Courage It, and we were formed in January of 2010. And also, Leslie, thank you for mentioning how we've been shipping our first product, the FlipPal mobile scanner, for about 2.5 years, and we've hit a little over $4.5 million worth of revenue. We have 9 employees. And we're international now. We sell not only in the United States and Canada, but United Kingdom and New Zealand and Australia. And we've
Boy,
come
you're
a long
growing
ways.
like gangbusters, aren't you?
We really are have a lot to be thankful for. It's a great product, and we have some really great people that have been attracted to our company because of our values and the way that we founded the company based on courage and integrity, collaboration, innovation, and care. And you know that middle C, the collaboration aspect, is such a key component, and that's one reason I really believe strongly in reaching out to other entrepreneurs who are starting or thinking about starting their own company, because the lessons that I've learned in nearly 3 years of raising funds to get that sort of growth has been a lot of work, and I would hope that other people don't have to maybe go down the paths that I had to go through to reach a dead end and then come pop back out and try something different. And you know, in these days, since 2008 or 9, raising funds is very different. It's a whole new world out there. Prior to that, you know, angels were fairly open with their money. There was some venture capital money here in northern Colorado for things other than software or social media or medical equipment. But it's really tightened down since then. So you really, as an entrepreneur, need to think a little bit out of the box and find ways that might not be traditional methods to get your company off the ground. Because if you wait around for the funding, well, I'm not a very patient person. And if I had waited for conventional financing or some of those other methods, I wouldn't be where we are today. And I'm very grateful for the people and the events that have helped us get to where we are today. So with that introduction, I thought I would just let you know some of the things that I've discovered. But it all starts right here, which is deciding the goals for your company. And what I'll call a liquidity event. Many times investors will call that an exit strategy or you know, a sellout or something like that, but that might not actually be the type of liquidity event that you're looking for in your company, and it isn't for me. I'm not intending to sell Courage and out and walk away with a ton of money. It's something different for us as a company to build something that lasts and has created jobs in Colorado and will continue to do so. But really, everything that you do with your fundraising really needs to be hinged and targeted towards what is it that you intend to accomplish with all of this work. It is a tremendous amount of work to start your own company. As Carl mentioned, maybe a fine line between crazy and an entrepreneur, you know, and sometimes I wonder that myself. What have I got myself into? And, you know, the story about how entrepreneurs sleep like a baby at night. Well, you know what that really means is that you wake up every hour and you've got something else that's on your mind, something else to do, and my time and mental energy, fundraising has been a significant portion of that. Well, I'm going to break up this topic, which is very rich. As you know, raising money can range from all different areas. But today I would like to just talk about debt types of financing, and bootstrapping, typical bank financing, convertible notes, royalty or amortization, factoring, and supply-side financing, which oftentimes gets overlooked. And for another time, I'll take a look at a few with equity. in things like private placements and direct public offering. I've done both of those. And in fact, I've done crowdfunding too. I'm the only one of, I think, 6 companies in the nation that now is doing crowdfunding for equity, where we're actually selling shares in the company without having to wait for the jobs bill Title II to take effect. And also you could be thinking about a public offering and going with an IPO. That is not what my company wants for its long-term future. And so I'm not going to be talking in either of these 2 presentations about a direct or an IPO or even moving forward in that direction. You'll have to find somebody else that has that sort of a goal to give you the details about that.
Thanks for hitting our appetite here on the crowdfunding. I know that's going to be a popular topic for people, but that's not this presentation. That's going to be Module 6. So hang loose, everybody, on that one. Are you going to talk more about what the definition is of how you're talking about liquidity and why you're using that term?
It's a really important thing for everybody to consider. For an investor, they want to know when they're going to get their money and how. Because they may, or the types of investors that you're seeking will each have a little bit different goal for their financial results. And in general, an angel will want to look for maybe a 10x return in 3 to 4 years, because they're in the very early stage in investment opportunity, and they tend to gamble on 10 people, each of which has, maybe a 2 to 3 to 1 chance of succeeding, but when they do, they hit it big. Well, that's a different type of a liquidity event than, say, an IPO or an acquisition, where the early stage investors get their money out quickly because somebody else has purchased the company and now the stock has been cashed out. For that, so the liquidity event refers to, from the investor's point of view, when do they get their money back?
Oh, okay. And so it's the point at which you become really self-controlling of your future then.
Actually, I wouldn't say it that way. I would say, again, it's from the investor's point of view. When is it? What event is going to allow them to get their money and convert their shares into something that's cash, or the cash that they put in? So it's a cash out event, I guess you'd say. Okay?
Thank you.
And an acquisition would be an example where some company comes in and simply pays you, what, $5 million for your company after you formed it. You walk away with 2, and the investors, depending on the equity structure, walk away with 3, divided up about how they each own portions of the company and shares of stock.
Okay.
Okay. Now, let's move forward, if there's no other questions, to this topic, which is, okay, what is that liquidity event, and what are your goals? Well, the first option is to go public, which would be, we're actually traded on the public stock exchange, like New York, Dow Jones or something like that. Oftentimes that also takes a form of getting acquired by a company that's already public. I've had people approach me and say, I'll convert your Colorado C Corp into a public offering, and oh my gosh, that is quite expensive. You're looking at $30,000 to $40,000 to do that, plus you now have many reporting requirements that will burden your company, so you really want to think seriously about that. For Couragen, we have decided to stay privately held and grow as we continue to have our shares be privately held, but not traded on the publicly available exchange. Now, people that talk about going public, they'll talk about an initial public offering, an IPO. And venture capitalists. Well, my experience, and I can get in a lot of trouble here, is that vulture capital is really what VCs stand for. They really do want to see a quick exit, lots of cash out at the end, and they want to be, they'll say, actively involved in your company, which means they typically want to have a board seat, a high level of voting shares in the company, so that they have a fair amount of direction on how you run your company. So if you're interested in a cash, quick exit, and you don't mind giving over control of your company, I think that a VC or IPO, Series A, Series B kinds of rounds would be just fine. That's not the goal for my company, though, Couragen. What we've done instead is take an approach of staying private and seeking investors, many of them. Many small investors rather than a few large investors, which would be a venture VC or maybe even an angel. And so that gives your company quite a bit different character than it would be if what you're trying to do is manage the numbers in order to make your VC or angel get their cash quickly. And what we're doing with Couragent is really building a company that has a solid foundation and will be passed on to other people who rise up through the ranks, if you will. But this is a really, really important thing for every entrepreneur to decide up front. It's not just a matter about getting the money and getting the cash, but what is it that you want to do with this venture, and what is your long-term plan for the company itself? It is a certainly large time commitment. 24/7 is oftentimes the way your time will be managed as an entrepreneur. And I would say at least one of your 40-hour-a-week jobs will be spent as CEO raising funds. And if you want to be successful at that, it is going to take a lot of time. So just be aware of that up front, that fundraising is one of the most important jobs that you will do as a CEO, that you will have other people and employees come on board who can take care of the operations, the technology, the marketing. But as the CEO and the founder, you're the person that these investors are going to want to talk to, and you will want to be prepared for that. Which brings me to this next subject is what is your comfort zone in terms of pitching or selling your company? Are you okay with talking to friends and family or individual investors in a one-to-one sort of a meet over coffee kind of a forum? Do you mind standing up in front of a group, an angel group like the Rocky Mountain Ventures groups or high altitude investors or the Colorado investors here in Fort Collins? Oftentimes those are on a podium and you're sitting there standing in front of 150, maybe 200. I've given pitches to 1,500 in the Valley area. It's a big deal. You've got television screens flying and people all watching your time, and it's a big deal if you want to be able to be effective with pitching to the larger groups like that. Maybe you're okay with just attending networking events and businesses down in downtown Denver where you just kind of hang out and have a drink with some people and you talk business. That would just be a simple networking event, that it's more conversational than it is pitching. I've done direct public offerings where I did pitches in hotel conference rooms by invite only, where maybe 8 or 10 or 12 individual investors will come and I'll do a 20-minute pitch with a slide set on a PowerPoint presentation, and they invest after the end of that. Are you okay with doing that kind of presentation? And there's also a whole new range that is coming out from the crowdfunding, which is more about social connections and having people that are going to invest in your company be connected with you on a very personal level. And the more successful crowdfunding events or campaigns have events maybe in your home or in your other employees' homes where you invite your friends to come and talk and just learn about the company. It's very informal, almost like a Friday afternoon club sort of an environment. That might be the area that you're most comfortable presenting the opportunity for people to participate in the success of your company by being an investor. Well, I just encourage each person to think through what it is your comfort zone is in order to determine how you would go about raising funds.
Here's an interesting question, Gordon. You talked about the fact that you personally need to be out there giving presentations, shaking hands, doing deals, all of that good stuff. To what degree do you have a team that's going out and doing that, or is it all on your shoulders personally? Do you have a senior team that's out there also giving presentations, shaking hands, giving pitches?
Great question, because absolutely, especially for the larger events where you're pitching in front of an angel group of, well, even the ones down in Denver, I'll bring along my technology guy and marketing person, and after I do the pitch, which is pretty much a one-person pitch on stage, they'll come on stage and help answer questions. And it shows that they're, to the investors, that they're investing in very competent people. It's not just about me as the CEO. And that's a really important point. Whenever you're pitching to investors, the smart ones realize it's as much about the people as it is the gadget. You don't want to be a one-horse pony or a one-pony trick, whatever they call that, to be able to attract investors. And by doing those pitches in person, absolutely have multiple people there. But also in terms of spreading out your networking. And the reason I'll have to defer a better answer to that is when you do the private placements and even the crowdfunding, a lot of it is about how you're connected with others through social media, and therefore every person on the team is a connecting point to their community, their tribe, that then can connect to others. So it really is a group effort. But when it comes down to making the deal, they're going to want to meet the CEO.
Okay, great, thank you.
Okay. Well, let me move forward to what is the usual starting point, which is bootstrapping, which means you take your own funds and your founding members and everybody puts in what they can and bootstraps the company using their own funds. Well, I actually spelled that wrong, bootstrapping instead of bootstrapping. But really, this is the most effective if you've already got a job, you're thinking about starting a company. We've got one person moving around here.
Leslie, is that you?
Aaron can come in tomorrow.
But anyway, if you want to start a company, it's best if you have an employer and you're thinking about doing something in a year or two, you can start laying the groundwork. Or if you have somebody else in the family, a second breadwinner that can carry the torch for you in terms of making your life expenses running the home happen while you're moving forward to starting your own company. But it does, for me at least, you have to reduce your home expenses. It was helpful to us, Karen and I, that our children had grown, they were through college, we had pretty much paid off our portion of their college expenses, and so, our monthly cash flow we reduced it just significantly. We sold off the toys, if you will, the extra land in the mountains, maybe a motor home or boat or things like that. Those are things that you're going to let go of in order to get your new company started. But it really is so important to have your spouse or your partner be there right alongside of you. This is not well, I'm going to go do my own thing and follow or out. This is really something that it's critical to have success, to have the person that's alongside you be there actively supporting you. But bootstrapping gives you the ultimate amount of control, right? I mean, it's your money. Nobody's going to come along and say, I think you should change your marketing plan to be XYZ instead of ABC. This is, you have the most money in, and that then gives you the highest degree of control of what gets done in the company. And it also gives you the ability to determine your corporate structure. It might be an LLC, it could be an S Corp or C Corp or even a partnership. When you're in this bootstrapping phase, you really have the hands on the wheel. You've got the tiller in your control, and you've got the ball going forward in the direction that you want. Any questions about bootstrapping before I move on? Yeah, that's where you're really getting yourself engaged in the company. This is your money. In my case, I left HP after 31 years. I took that severance money and sold some land up in the mountains and put all of that money into starting Courageant.
Yeah, I have a bias towards that as well, and we've talked about that a little bit. So let's get on to the other ones where we are getting really creative now.
Okay. Well, actually, the creative stuff I think falls more in the equity side, but actually the conventional loans, where you go into a bank, it's the community bank usually, and they've got a small business development loan thing. Well, those almost always require a personal guarantee from a portion who own 50% of the shares. Well, because I have raised money from 44 shareholders, it would take me about 14 people to make up 51%. And there's no way I can go to those individual people and say, hey, would you fill out this 20-page document for the Small Business Development Corporation that guarantees that if the company were to default, you would personally have to, guarantee that loan. It doesn't work for a company like myself, where we've spread out the equity structure quite a bit. But just be aware that if you want to walk into a bank and get an SBDC loan, you're going to have some tangible assets and be willing to put your personal fortune on the line in case you can't make the company go. Now, of course, from the bank standpoint, they say, well, that just demonstrates that you've got sweat in the game. Well, I think for most of us entrepreneurs, there's no lack of sweat in the game. I mean, we've got our whole mind, heart, and soul wrapped up into starting this company. So I don't know that that really represents or demonstrates sweat in the game or commitment to the company. As much as it does, of course, the joke around entrepreneurs is a bank will give you a loan if you can demonstrate to them that you don't need it. And I find that banks really have become very risk-averse since '08 in terms of lending money to a company that doesn't have tangible assets. In many cases, most of what we have in terms of our assets are intangible, intellectual property or other types of assets that are not going to be useful when applying for one of these conventional loans from a bank. You could look at a line of credit, and I was very fortunate to get a line of credit from Wells Fargo. And to do that well, and you have a product like mine where we have some seasonality, I timed my application for the LLC to be the time of year when I had the most cash, which, there are times of the year where I don't have a lot of cash, and I would not have been able to get a line of credit at those times of the year. So if you are interested and you think you have a reasonable chance of getting a line of credit, figure out the time of the year that you're most likely to get the most amount. Depends on your business. There are plenty of people out there that will, I'll call them sharks, not afraid to say so, because they really want to get the teeth in your company and get control of you because they've got some expensive money that they've given you, and now the next time around they're going to charge you perhaps even more. So I'd stay clear of deals that are too good to be true. The one that did work for me, that's why I got a check mark in front of that, is I did get 120 days terms open account from my supplier, which is, typical in the industry is maybe 60, 90 is pretty darn good. But because my supplier recognizes that it takes a lot of capital at the front end to start a company, he was willing to give me 120-day terms. So that's basically free money for, an extra 60 days. That was a very helpful thing. Don't rule out negotiating terms with your supplier at the start of your company. I think those are very viable kinds of things.
Yeah, and thank you for that one, Gordon, because I think people often do overlook and just go towards the people that say that they're in the money business, but in fact, partners and suppliers, and I've heard people who have customers that give them generous terms.
Yes.
In some situations, so that can be very
all
powerful.
Of those are good. Yes, absolutely. And it's in there. You can actually make a very persuasive business purpose for them, right? The supplier gains because if you can make a very successful business out of selling their product that they're supplying to you, they come out ahead, right? They sell more product because you're being successful. And likewise, your suppliers, the people that give you parts, with the flip out, we sell carry cases and battery chargers and these other accessory products. Well, those people also come out ahead by giving you some good terms because they're helping you be successful, and you can really make a great business case to those people and say, hey, this is not just no donation to the company hoping that we're going to do well. This is in your interest to help us be successful, particularly at the startup phase. Yeah.
Excellent.
Let me move on then to what is called a convertible note. Well, a convertible note is really nothing more than a promissory note. It's a loan, but it can be converted to equity. And it actually represents a very good first step. At least for the investor, typically these kinds of things are, well, I'll give you that first example. My first private placement was a 2-year convertible note that had an 8% simple interest with a 20% discount. Now what that means is, yeah, somebody put in, say, $10,000. Over 2 years, they get 8% interest over that, and then it can convert to equity at a 20% discount. Well, for our people, that represented about 180% return in 24 months because they all took that portion, the principal that they invested, plus the interest that had accrued, and converted that into shares because they got this 20% discount. The price of the shares had gone up from $1 to $1.25, and then they were able to buy it at 80 cents. So they saw a return in both the paper value of the shares and also the fact that they received interest during that period of time. Good deal for them. And it represents a little bit less risk for the investor because they actually have a note. They have, they can ask you at the end of the term to just give them the principal and interest, not convert that to shares. But they do have the option then to, see the upside potential because they've helped you get started with the first year or two, and now they can see even further growth in the company by converting it to equity, shares, stock. And you always only issued common shares. In some cases like this, you might structure your equity structure to include preferred shares also. But I was very successful in using that convertible note for our first private placement. In addition to that, on the supplier side, we had about $640,000 that were spent on developing the engineering for that. The PC board design, the firmware, the tooling. Well, the supplier converted that debt into a 5-year note with a 3% interest and a 20% discount. Well, that's excellent money. A 3% loan for 5 years in today's market was quite a deal. And we've been paying that down at a monthly installment payment. And even in the 18 months, we've been paid that down by a significant amount. So this is an excellent example of using a convertible note with a supplier for companies that are pre-revenue to get the development costs taken care of by the supplier. Again, because it's in the supplier's interest to help you get your company started.
So here's an interesting question, Gordon. Given that you're not a public company, when people are buying shares at a 20% discount, exactly what are they buying?
We issue them a stock certificate, right? And they're registered in our shareholders record with the SEC. So they've got shares of stock. It's just that it's privately traded. It's not publicly traded, which means they can, sell their shares to somebody else, their friends or family or anybody else. And our company has the first right of refusal, at least that's the way I've structured my deals, that if they wanted to sell it to somebody for less than the market value, I have, as the company, the option to buy it directly from them instead. But again, this is a private transaction. It is you and me meeting, and we shake hands, and you write me a check, okay, or you write a check to the company. It's not like you go to the stock exchange and have a broker-dealer take the money and then purchase the shares on your behalf.
Excellent. Thank you.
Okay. Well, let me move forward then to another option, which is for people that are pre-revenue, you can also amortize the development costs. For example, if I were to, instead of using that convertible note, if I had, for that example, $600,000 for all of the engineering work, we had talked with our supplier for a while about just adding, say, $30 onto the product cost for the first 20,000 units. And then after they sold 20,000 units, I just pay the purchase price for the scanner itself. Well, that also is a great example of supplier-side financing, where you just amortize a certain amount of off-the-top profit in order to pay back your upfront development costs. And that's a win-win. As long as you reach the payback quantities, the supplier comes out, heads up, and you've got some relatively inexpensive money up front that you pay back over a period of time, depending on your sales volume. For me, that was just less than a year. So doggone it, that the supplier made out pretty darn good on that for both ways. So think about the amortization when you're dealing with your supplier or anybody else that would be giving you some pre-revenue upfront money in order to get you to the market.
So that's similar to some of the Shark Tank deals that they've been trying to do, where people would put in money, and part of the return that they'll get is a certain amount of royalty for each
Yes.
unit sold until the money's paid back, and then it goes down or it disappears, right?
Actually, I was going to cover that as a separate type.
Cool.
In that the amortization is actually part of the difference between these two, in my mind anyway, is that amortization is to pay for upfront development costs over a phased period of time. Whereas, those deals that I've seen on Shark Tank also, or royalty-based financing, is the investor gives you the upfront monies, and they get a portion, a royalty on each sale. And I've seen deals on Shark Tank where they wanted that for perpetuity,
Yep.
And it's like, forget it, folks. You don't want to give away your farm for that. I would strongly recommend, if you're looking at a royalty-based financing scheme, to have a cap, which in this example that I drew up here, if you were to take $500,000 up front, there's multiple people that'll do this. You can go to the web and search on royalty-based financing, and a couple of really well done websites will come up, and they're all good from what I can tell. There's no sharkish sort of aspect to these. These are upfront deals. They give you $500K up front. I would insist on nothing more than a 20 or maybe a 25% cap, which means they get, for example, 10% on the revenue, and you were selling $200,000 a month. In 30 months, you would pay back the $500,000 plus a 20% cap, right? $100,000 is sort of what they take off the top from the deal. That's a good return. If you were to do this in perpetuity, that kills your margins, right? You don't want to do that. Make sure if you've got a deal going down with either a shark or any kind of royalty-based financing that you've got something in place so that once you've satisfied the obligation to pay back that principal plus some profit for the guy that's putting his money in, I think 20% return for this kind of a deal where you're in revenue and they've got a fairly strong flow of funds each month, there's no reason to give up in perpetuity in any kind of a royalty agreement. Unless you really think that the whole thing is going to die in 18 months and it doesn't really matter anyway. But, with our products from Couragent, all of these are, 8 to 10 year lifetime types of products. So I would never give away perpetuity on a royalty-based deal.
Excellent. Thank you.
Yeah. But, just think through those two. There's a minor difference between royalty where you're in revenue and amortization where you're pre-revenue.
Okay.
Okay. And then another area that you will hear a lot about, and if you go to events, you'll have several people, if you've got a really good business plan, that'll come up to you and say, let's talk about factoring. And in this case, a financer or an investor will give you the upfront money to purchase inventory where you have a committed order. And maybe it takes you 90 days to build 10,000 units. But you've got this sweet deal from Best Buy and you just don't want to pass it up. But you don't have the cash. It might be it takes you $100,000 to build up that much inventory. So you've got a person that does factoring. They'll bring you the $100,000. They'll charge you an armful for it. 11 or 12% interest, but it's for a short period of time, just long enough for you to get the inventory here to then sell to Best Buy. Sounds great, but I'll call this candy money. It is sweet to get started, but it doesn't last. It's a quick high, and it will eat your margins. It's expensive money, and you're basically taking money from Peter to pay Paul, because the next time around this deal comes down, you're going to have to do the deal all over again. It's not quite a prism scheme, but it's pretty darn close. So be very careful from that. I would say it's not far from a true loan shark, that once you start down the path of factoring and you're building high volumes of your product, it's pretty hard to get yourself extracted from that. You've got to have a fair amount of discipline and predetermine what is your last step in factoring, or else you're going to be doing this forever, and your margins for your company and the money you put in your back pocket is going to be eaten up by somebody else.
So what I'm hearing is that you might consider it if it's a truly unique case where that would be the exact fix for what you need, but that you have figured out in advance how you're never going to have to do it again.
Yes. It's not a sustainable business model.
Yeah.
Unless you've got huge margins, 100% margins. Well, you don't mind if you give another 12% up to somebody else. Now, the example where you might take advantage of this to your benefit, for example, with FlipPal. I did a deal with Woot. Those are the guys that sell things for really cheap, but you get enormous exposure. Well, I couldn't build those units and pay for those out of the cash in hand that I had. Well, I went out and got some factoring money because I had a hard deal with them, and what that did is it turned out to be more of a marketing exposure play, almost like a a Trojan horse strategy. And I made that one deal. It was I didn't make any money from the deal. I got some great advertising, and then I created a whole new set of resellers who saw that Woot deal and then contacted me in ways that I would not have been able to do by trying to self-fund a marketing awareness campaign based on the same amount of money.
Great example.
But
Thanks.
You got to run your numbers. You don't want to walk into a deal. I've heard lots of people feel enamored with home shopping networks or one of those deals where you sell out in 7 minutes or something like that. Run the numbers. Just make sure that you aren't going to end up at the end of the deal shaking your head and a bill that set you back $10,000 or $15,000 because you didn't really look at the numbers. And yeah, you sold a lot of units, but you can't make money in your company if you sell lots of units at a net loss for each one.
Yep.
It's lots of fun. I mean, to be in home shopping networks, I've done that. It's lots of fun. And you can use that also for a pitch to your investors. You can say things like, sold out on home shopping networks during Christmas season, and that makes a great story, and it might be worth it for you to do that type of expensive money to buy the inventory to make that kind of a deal, but don't make that built into your business model unless you've got large margins to start out with.
Excellent. Thank you.
Okay. Well, that wraps up my part of that, and I do have lots of also information about equity financing where you're selling shares, but that's a show for another time.
Excellent. Thank you so much. Leslie?
You're welcome, and I'll turn it back to Leslie.
Gordon, thank you. Every time I listen to you, I'm so impressed, and I learn so much more, even working in the franchise financing model, hearing alternatives to financing for people who are looking at other types of businesses. You're just such a depth of information on it, and I so appreciate you being on the call today. And I hope everyone learned something, and we'll look forward to having you, Gordon, back very soon on your second section of the financing on crowdfunding, because I know that's been a very popular and very innovative topic, so I'll look forward to hearing that. So I just want to conclude today by thanking everybody for taking some time to listen to this great presentation today. I'm Leslie Lautzenhiser with FranChoice, and my piece of this game is I help people who are thinking about getting into business that have sort of aligned themselves up with a franchise being the right opportunity. I provide a free service where I work with them to help find the franchise that's the best fit for their long and short-term goals and their lifestyle. So, Carl, again, thank you for being on the call today. Carl?
Hi, this is Carl Dierschow. Thanks so much, everybody. Good session today. This is an interesting topic. I know there's a lot of depth here that people want to get into. I'm a small business coach. I'm with Small Fish Business Coaching, and I work with people who are looking to grow new businesses as well as take existing businesses to the next level. So thanks, everybody, for being here for Module 5. We will come at you soon with Module 6 and bring in Gordon for another great presentation. Thanks a bunch. Take care.